What's up, everybody? Welcome back to another episode of the Engineered Impact Podcast. I'm Dan Korth, and today we're rounding out our series on the perfect savings vehicle. And over the course of the last few episodes, we've talked about the benefits of using whole life insurance policies with mutual insurance companies as basically the most powerful savings account in the world. Okay, we've talked about some of the big benefits. We've talked about liquidity, the fact that you've got access to your money anytime you want it for any reason without credit checks and lengthy application processes. We've talked about the safety of your money and how much more capital these insurance companies have compared to traditional banks, and the safety of your money, just of knowing that your money is there whenever you need it. We've talked about the higher rate of return that these policies generate, on the order of 4 to 5% compared to like 0.01% in a traditional savings account, maybe something approaching 1% like a money market or a CD account. Today, what I want to talk about is one of my favorite benefits, and that's the tax-free nature of these policies. Okay. Now, taxes are the biggest financial liability that most people will ever have. Okay. We get taxed when we make money. We get taxed when we invest. We get taxed when we spend money. We get taxed when we buy gas. We get taxed on our property. We get taxed when we die, right? We are taxed literally every transaction we make almost throughout our entire lives. Okay. So the typical approach to taxes when it comes to retirement planning is to defer them and pay them later, right? We all know that reducing our taxes is good. And so when we sit down with our HR department or our financial advisor, they say, look, you can reduce your taxes by stuffing more money in your 401k or an IRA or whatever it is, right? So that's a traditional approach. Let's defer that biggest liability to someday later. And as we've talked about before, the rationale behind that is, well, you should be in a lower tax bracket when you're older, right? Well, I don't really buy into that argument. If you've listened to this podcast for any length of time, you know that my opinion is that being in a lower tax bracket is code for you're going to be poorer when you retire than you are today. And that doesn't sound like a good deal to me. I want to be at least as rich someday when I'm retired as I am today, right? And so, your financial advisor is probably going to tell you, well, you don't have a house payment anymore, and you don't have kids at home anymore, and maybe you don't have a car payment anymore. So you don't need as much income. So you're going to have less income, but you'll have less expenses, right? But that doesn't make any sense to me, because for me, the money that today I'm spending on a house, and I'm spending on my kids, and I'm spending on cars, and all of the things that come along with being young and or middle-aged, that's the money that when I'm retired, I want to be spending on traveling and having experiences and doing all the things that I deferred while I was working, right? That's my approach. So I don't want to be poor and just living, just covering my basic expenses like I'm doing right now. If that sounds okay to you, all right, peace. But I want to be at least as well off, have at least as much income and at least as much purchasing power when I retire as I do today. Okay. So that said, I would prefer to pay my taxes now all day long. Okay. Let me tell you why. The United States has a little bit of a math problem. Okay. Our national debt in the last 3 months since COVID-19 hit has spiked $3 trillion. Okay. The United States has gone from $23 trillion in debt at the beginning of 2020 to $26 trillion today. Okay. And if you've ever looked at the U.S. debt clock, you can't even keep track of how fast those numbers are moving. Okay. If you were to pile up 26 trillion $1 bills, you would have enough dollar bills. You could create 7 stacks between Earth and the moon and still have enough left over that you could circle the Earth almost 4 times. Okay, with the dollar bills stacked like this, you could still go around the circumference of the Earth almost 4 times, right? That's a lot of dollar bills. It is mathematically impossible for the United States to ever pay that back, okay? I don't care how many billionaires and millionaires and private jets you think are out there. There is no mathematical way to ever pay that back, okay? That's fact number one, $26 trillion in national debt, okay? Now, that's just the money that Congress has spent above and beyond tax revenues on government operations, okay? Now, on top of that, we've got a couple programs called Social Security and Medicare, right, that are funded through payroll taxes. When there are surpluses in those payroll taxes, they go into a trust fund, okay? Well, the Social Security Trust Fund at the beginning of this year was projected to be depleted in 2035, okay? No more money, no more surpluses, other than all they have to work with is what's coming in from current payroll taxes, okay? When COVID-19 hit, 40 million people lost their jobs, and it moved that projected date into 2029, okay? Think about that for a minute. 9 years from now, the Social Security Administration, the government themselves, is saying this money's gone. Poof. No more Social Security Trust Fund. Okay. Now, do you think Congress is really going to tell retirees, hey, you know what? All we got left is what's coming in payroll taxes. That's only enough to cover about 75% of what we owe you. So sorry, we're going to take away 25% of your payments. Now, they might do that. That's an option. I don't personally think they're going to do that because it's political suicide. So what is their option? Well, the only option they have left is to jack taxes way up, okay, to cover that extra 25%. I personally think that's what they'll do, okay, combined with inflation. Now, according to the U.S. debt clock, in terms of unfunded Social Security and Medicare liabilities, in other words, what the government owes retirees in addition to what is sitting, the still hundreds of whatever it is, the lots of dollars that are still sitting in the Social Security Trust Fund. I don't know what that exact dollar amount is, but it's a lot, right? But above and beyond whatever's left in those Medicare Social Security Trust Funds, it's estimated that the government owes $148 trillion on top of that amount to retirees in the future. Okay, so these are promises that Congress has made to the American people above and beyond what's funded. Okay, so think about this. If you took, the government pulls in about $4 trillion a year in income tax revenues. Okay, at least they did before the 40 million people lost their jobs due to the COVID. Take that back. The government's response to COVID-19, that cost 40 million jobs so far. So that's going to cut in that $4 trillion. But let's say that the government continued to make $4 trillion a year in income tax revenues. Okay. Let's say that they quit spending money on anything other than focusing on paying down this $148 trillion that they owe in Social Security and Medicare liabilities. Okay. It would take them 37 years, 100% of tax revenues just going to that to burn that down. Okay. And they'd still have the $26 trillion in debt that they've already spent above and beyond what they brought in historic tax revenues. Okay. Now, obviously, that's never going to happen. So, point being, these balances are just going to go up and up and up and up and up, right? The government is spending trillions of dollars a year it does not have. So, bottom line, I'm not sharing all this to depress you, right? What I'm trying to do is just simply highlight that the United States government has a math problem. They have a liability, a series of liabilities they just can't ever pay back, right? There is no reasonable scenario where tax rates aren't higher in the future because they have to deal with this, right? Now they're going to delay it as long as they can. They're going to try and inflate the dollar and whatever they can, but there's just no reasonable scenario where tax rates don't go up, right? So when that's the only logical conclusion of the facts, that mathematically tax rates just have to go up to allow the government to deal with this, why would we delay our biggest financial liability that's already taxes anyway, and that's only reasonably going to get worse? Why would we delay that till later, right? I would much rather pay that liability now, take care of it now, and be done with it. Never let the IRS touch that money again, okay? Now, on top of the math problem, think about this, okay? We talked about this a few minutes ago, right? Your financial advisor is going to say, well, you don't have a mortgage payment anymore. You don't have kids at home anymore. You don't have the expenses that you used to have, so you don't need as much income, right? Well, again, if you're like me and you don't want to be poor when you retire, those two things that you don't have anymore also mean you have no more tax deductions, right? Because it used to be that you could, when you had those things, you could write off your mortgage interest. You could write off expenses for having kids. You could get tax credits for having kids, right? Well, those are all gone now. And so whatever income you do get is now completely 100% exposed to the IRS, okay? So all that considered, again, I would much, much rather pay my taxes on my seed money today and then go save it, then go invest it, and never ever pay those taxes again. Okay. Well, as it turns out, a whole life policy with a mutual insurance company will allow you to do just that. Okay. And there's two ways that works. First, any dollar that you contribute in premiums to these policies can be withdrawn tax-free as long as we follow some simple rules that the IRS has sent. Okay. Because essentially what the IRS is looking at is that these withdrawals are a return of the premiums that you've paid. Okay. So there's no tax on it because the insurance company is just giving you money back that you're allowing them to hold, essentially. Okay. Now, what about the 4 to 5% growth that those dollars you contributed made for many, many years, right? Well, you can also access those dollars tax-free through policy loans. Okay. So just like we've talked in previous episodes about, you can take policy loans and use them for vacations or investments or putting a backyard in or whatever you need. You can take those policy loans as income. Okay. After you've depleted everything that you contributed, now you can access the rest of those dollars as a policy loan. And just like any other loan, it's not taxed, right? It's not taxable income. Okay. Now, if you're asking yourself, well, Dan, I don't want a bunch of loans and a bunch of debt that I have to pay back in retirement. Well, that's the magic of this. Okay. The insurance company doesn't care. They're never going to send you a bill. They're never going to ask you to make a payment. Okay. Because at the end of the day, if you have outstanding loans, when you pass away, they're just going to deduct that amount from your death benefit. Okay. And once I'm dead, I don't really care. Now, if there's anything left there, I'm happy to pass that on to my estate, but that's not my primary concern. My primary concern is building an instrument that I can use in my retirement to support my financial freedom, right? So you can effectively draw down the entire value of the policy through these two vehicles completely tax-free. Okay. So think about what you could do with what today is probably an extra 22%, maybe 24% that you would pay if you were taxed on your retirement savings today. What could you do with an extra 22 to 24% of your money in retirement? And then think about what if those tax rates are 30% or 40% or 50%, okay? Think about giving up half your retirement savings to the IRS before you ever get to see it. Now, I'll tell you, I will never forget the first time I took a 401k withdrawal. And I'm so glad I did this when I was young, okay? I was, 34 probably at the time when I did this the first time. And I'll never forget getting the check because I saw the amount that I was withdrawing, right? And I was like, oh man, this is going to be awesome. It's such a big number, right? And I'll never forget when I actually got the check after they withheld the taxes, I was shocked. Now I knew in my head, I knew that money was going to be taxed. I knew that I'd been deferring the taxes and that I had that liability, right? But it really made me realize, one, just how much of a huge, huge hit you take when you take that money out of the 401k. But the other thing it made me realize is the number that my 401k company is showing me when I log into my balance is kind of a lie, right? Now I know in my head that not all of that money is mine. A big chunk of it is the IRS's, but what they're showing me is the full balance, right? And it's kind of a lie because that's not what I get. If it's telling me I've got $1 million saved up, I don't really have $1 million, right? I've got maybe 80% of that. So, just think about that. Look at what is the real impact? Do that math and, look at what you've got in your 401k or your IRA and figure out, if you take out 22% of that or 30% of that, what do you really have? Okay. What does that do to your retirement? How many years of retirement income does that cut out? Okay. Taxes are a massive eroder of wealth. Okay. We all know that instinctively. And that's why it's such an easy sales pitch to, hey, defer your taxes because we're doing now what we know is a smart thing to do. The problem is we're setting ourselves up for a massive hit in the future at a rate that we just don't know. The IRS gets to define that. They get to change it whenever they want, whenever Congress gets to change it whenever they want. We have no say in it. And all we can do is just take it, right? We get the check after they take that out. Okay. Now, using these policies, this is not tax evasion, right? We're paying our taxes up front. It's not a loophole for the ultra rich. Anybody can do this, right? It's simply structuring our finances in such a way as to be the most tax efficient way possible, right? That's all we're doing. There's nothing wrong with that. That is inherently American, right? This entire country was founded on tax revolt, right? Nobody, I don't care what anybody says, nobody has a patriotic duty to structure their finances in such a way as to maximize the amount of money they give to the government. Politicians don't do that. There's absolutely no reason you should be doing it. Okay. So if you step back and you look at when does it make the most sense to pay your taxes? Does it make the most sense to pay it now on your seed when rates are probably the lowest they'll ever be in your lifetime? When, if you're like me and you've still got kids at home, you've still got a mortgage, you've got deductions to help with those things, to help offset those tax liabilities. I would much, much rather pay those taxes on my seed money and then put it to work, letting it grow for the rest of my life and be able to take those dollars out tax-free. Okay. A whole life policy allows you to do that. You'll pay the taxes once and then put those, plant those seeds that are left over after you pay the taxes. And years from now, you will reap a rich, rich harvest that is completely tax-free. Okay. To me, that makes much more sense. And it is one of the most powerful aspects of using these whole life policies. Okay. So I hope that has given you some food for thought, made you think about what you're doing with your money and really what kind of a liability are you setting yourself up for. All right. So that's what I've got for you today. I will catch you on the next episode. Have a great day.